Hi, my name is Catherine Jarrett, and I would like to discuss how corporations function. First, what is a corporation? A corporation is a legal entity that is separate and distinct from its owners. And so, what are the advantages and disadvantages of a corporation? Well, some advantages are limited liability, source of capital, ownership transfers, and perpetual life. Limited liability: the shareholders of a corporation are only liable up to the amount of their investments. The corporate entity shields them from any further liability. Source of capital is a publicly held corporation, in particular, can raise substantial amounts by selling shares or issuing bonds. And then ownership transfers. It's not especially difficult for a shareholder to sell shares in a corporation, though this is more difficult when the entity is private held. And then perpetual life. There's no limit to the life of a corporation, since ownership of it can pass through many generations of investors. And so, what are the disadvantages of a corporation? Well, there are three that come to mind. One's double taxation, the other is excessive tax filings, and then independent management. So, double taxation is basically, depending on the type of corporation, it may pay taxes on its income, after which shareholders pay taxes on any dividends received. So, income can be taxed twice. And then excessive tax filings, depending on the kind of corporation, the various types of income and other taxes that must be paid can require a substantial amount of paperwork. And the independent management simply is, if there are many investors having no clear majority in interest, the management team of a corporation can operate the business without any real oversight from the owners. Accounting for stock transactions commences once a state's approving body has authorized the number of stocks to be sold and the par value per share. This means that the corporation's capital account has been established and will be presented in the balance sheet as the stockholders' equity. So let's talk about stock basics. A corporation is a separate legal entity and has the capability to enter into legal transactions. It may borrow, lend, be bound by a contract, be held responsible for any wrongdoing, be sued or file its own lawsuit, pay taxes, and be expected to comply with all laws and regulations of the state. Every stockholder is a co-owner of all its assets and will be liable for its obligations in proportion to the number of shares owned. However, only those who have been designated, elected, or authorized by the board of directors in accordance with its bylaws shall have the capacity to represent the corporation in any of its legal transactions. And so stockholders' equity. This is also known as shareholders' equity, and it's one of the three elements of a corporation's balance sheet and the accounting equation. It's outlined as assets equals liabilities plus stockholders' equity. And lastly, capital stock. So capital stock is the combination of a corporation's common stock and preferred stock, if they have any. Common stock is usually the first and only capital stock issued by corporations. However, many corporations will also issue preferred stock. The amount received by the corporation when it issued shares of its capital stock is reported in the stockholders' equity section of the balance sheet. And lastly, the stockholders' rights. So, what are the stockholders' rights? The rights of shareholders depend largely on provisions in a corporation's charter and bylaws. These are the first documents which a shareholder should consult when determining his or her rights in a corporation. Shareholders also generally enjoy several types of rights. Some of those are they have voting rights on issues that affect the corporation as a whole. They have rights related to the assets of the corporation. They have rights related to the transfer of stock. They have rights to receive dividends as declared by the board of directors of the corporation. They have right to inspect the records and books of the corporation. They have rights to bring suit against the corporation for wrongful acts by the directors and officers of the corporation, and they have rights to share in the proceeds recovered when the corporation liquidates its assets. And so what's the relationship between net income and equity? Net income is the portion of a company's revenues that remains after it pays all expenses. It's what remains after subtracting cost of goods sold, operating expenses, and non-operating expenses from revenues. The owner's equity is the difference between the company's assets and liabilities. It's the owner's share of the proceeds if you were to liquidate the company today. The relationship between net income and owner's equity is through retained earnings, which is a balance sheet account that accumulates net income. And lastly, we must always consider the ethical issues related to any business transaction, any function of business. And so the ethical issues that affect a corporation's ability to function, in my opinion, the main ethical issue that I foresee is as it relates to corporate functions with its governance. Corporate governance is out and out a matter of ethics. It's about who is responsible to whom and for what and under what conditions. It refers especially to the way power and accountability flow between shareholders, boards of directors, CEOs, and senior managers. If the policies and processes by which a corporation is controlled and directed are not performed in an ethical manner, this behavior could devastate a corporation. The Bible provides us wonderful guidance, such as about how to conduct ourselves in an ethical manner as it relates to any business function. Proverbs 11:1 says, "A false balance is an abomination to the Lord, but a just weight is his delight." Thank you for listening, and God bless.